It's pretty simple. I mean, the global economy really has a cavity at this point, and people don't know whether to pull it or to just do a root canal. But the bottom line is cavities don't just go away. They tend to get worse. So we're a little worried about where the market has been. The last couple times I've been on your show, I've been saying that we're a little bit worried about where the market has been. And it really doesn't help to talk about, oh, is it going into recession or isn't it? Shouldn't the investor have something that they can do about this situation? And what we're saying they need to do is they need to buy some protection, a volatility strategy that can protect you on the downside while still allowing you to make money on the upside if things snap back.
Are you talking options, Randy?
No, there's strategies out there that some might use options. We have one that uses options that we sell or that we use for our investors. And you know, the options can actually make money when the market goes down. And so they act as a buffer. Traditionally, bonds have been that buffer for the last 50 years. But it's not 1974 anymore, and you know, Mr. Powell is acting kind of like it is, and interest rates are going up in anticipation of a recession, which is probably going to cause a recession if things keep going in this direction. So we think investors need to reach out and they need to look for alternative investments like this kind of volatility strategy or some other alternatives.
All right, let me turn to Tony and get your rejoinder there. You say it's time to nibble, if not jump in and buy the dip.
Well, our assessment, thanks for having me, Tyler. The assessment of the overall domestic and global economies is different. So we look out at the environment, and as Steve was just describing, we see a pretty strong economy domestically. So we look at, for example, manufacturing, non-manufacturing, ISM, various data, and we're still near cyclical highs. And I'll give you an interesting statistic. It's a little bit complicated, but bear with me. When we see a one standard deviation, the research shows that when we see a one standard deviation increase in volatility, and we don't go into a recession within the next year, okay, we're not forecasting a recession, there's a 92% chance that the equity market will be up at least 20% from the bottom of that volatility spike. And so, given that there's no recession, given that we're at 15 forward multiple levels now, given the drawdown in equity levels, given that we think that the rate environment continues to be accommodative. We're frankly not concerned about growth right now. Growth is still pretty good at 3+%. The risk factor here is around tariffs and trade. So if you take that out of the equation, we have a very rosy picture for investors. You put tariffs in, it's a wild card.